Great stuff. Sambasco is actually a change in estimate question, combined then a little bit with cash flow. Now, there's only 15 marks, so I can combine that very easily into a large question on cash flow. Or if I only need a few marks, then I can ask something like this as well. Sambasco ignores VAT and dividend withholding tax. They manufacture tires and support accessories for heavy construction equipment. The year end is 28 February. The financial statements for the year 28 February 2017 are finalized except for the finalization of the notes to the statements and the compilation of the statement of cash flow. Then they give you the statement of financial position, non-current assets, property, plant and equipment and investments, current assets, inventory, trade and receivables, cash and cash equivalents. Equity and liabilities consist out of equity, share capital, retained earnings, loan, short-term portion of the loan, trade and other payables, interest payable, and income tax payable. Also, a short extraction out of the statement of profit or loss, profit before interest, profit before tax, income tax expense, and profit for the year. Then they give us additional information, and it is actually all about non-current assets. They also give us a little bit of dividend information, but what they do ask us is to do the cash flow from investing activities, only that section of the statement of cash flow. Now, obviously, that section is about property, plant and equipment, and then obviously investments. So once you've written your headings for your cash flow, and you're only going to do investing activities, you can see that there was an increase in investments. So put that down before you're going to forget that. And in your statement of cash flow, you will have purchase of investments, 840,000. Then you've parked it, you have your half a mark, and now you can carry on to the more complicated stuff. Now they give us property, plant and equipment, the values as per the statement of financial position, which we know is the carrying values of those assets at the end of the year. Then they also tell us that the depreciation expense was correctly calculated and recorded for the year ended 28 February 2017 and was based on the following information. Depreciation on equipment is 20% per annum on the straight line method, factory plant 4% on the straight line method, and specialized machine they use the production unit method. Equipment had an opening carrying value of so much. The useful life of factory plant was re-estimated. It also came to light. They also gave you here the carrying value of this asset was so much as at the beginning of the year. Then the specialized machine, they also give you the opening carrying value of the asset was so much. So nowhere in the additional information, they give you enough information to split the cost price and the carrying value from each other. So in an instance like that, I don't have a choice. I have to work with a combined account. So what I'm going to do is I'm going to open up a property, plant and equipment account, which will be then a combined account. And the opening balance will be the carrying value as at your balance sheet, 8505, and there's your closing balance of 7980. 7980. Now we can start building the puzzle. Not that one. Right. Equipment had an opening carrying value of 777,000, and it was sold on 1 March for 420,000 rand. Now, the first thing that you should realize is that the 420,000 is the proceeds on the sale of equipment. So whilst you have that figure, go and dump it in your cash flow statement, then you know that you have it. Proceeds on the sale of equipment, 420,000. Also, they gave you the carrying value of the assets sold. And basically what they've done is they've sold all the equipment that they had at the beginning of the year, 1 March 2016. So there was no depreciation applicable on that equipment for the year because they haven't used the equipment. Then they say the intention of management was to replace the equipment with more technologically advanced equipment. The new equipment was delivered on 28 February 2017. 28 February 2017 is at the end of the financial year. So again, there was no depreciation on the new equipment either. So what we will have to do is we have to remove the carrying value of the equipment sold out of our property, plant and equipment account. So in our property, plant and equipment account here, as a disposal account, there it is to 777,000 Rand. Now, what they also don't give you is the cost price of new equipment. All they say is the new equipment was delivered and it was installed and paid for at the same day. No value. So obviously that will be our balancing figure. Hopefully, maybe one will whatever. But I must have enough information so that somewhere out of the next information that they give us, we will be able to calculate that amount. Now the next one is factory plant, and they say the useful life of the factory plant was re-estimated at the beginning of the financial year. A specialist confirmed that the remaining useful life from the date of the estimation, when was it re-estimated? At the beginning of the financial year. So it's important that you actually realize what the date was, and that was deemed to be 20 years. It also came to light that the plant which previously had no residual value was now deemed to have a residual value of 183,000 Rand. The asset register revealed that the carrying value of this asset was 4,935,000 Rand as at 1 March 2016. Now, what is our starting point? Let's just complete the rest of the question. Management decided to use the reallocation method to record and disclose the change in estimate. Now, what is our starting point when we use the reallocation method? Our starting point is the carrying value of the asset as at the beginning of the current financial year. Do we have that? Yes, we have. So the carrying value of this asset was 4,935. What does the reallocation method do? It only looks forward as from the beginning of the year, and I said as from that date. The estimated lifetime was 20 years and there was now estimated residual value. So it's a straightforward calculation. It's going to be the 4,935 less the estimated residual value. It's going to give us a depreciable amount of 4,752. The remaining useful life of the asset as from the date of the beginning of the financial year is 20 years. So 4,752 divided by 20 gives us 237,600. Depreciation on the plant, and let's go and dump it in our PPE account. Depreciation on the plant, 237,600. Then they tell us on 1 March 2016, the total, and this is the beginning of the current financial year, the existing specialized machine had a total capacity of 40,000 units and an opening carrying value again of 2,793,000. The production statement revealed that 12,070 units had already been manufactured up to this date. And what was this date? 1 March 2016. What does that represent? The beginning of the current financial year. Production for the current year was 1,215 units. As a result of accelerating technological changes, the total production capacity was recalculated at 25,000 units and the zero residual value. So initially there was no residual value, was now calculated to be 400,000 Rand. Management decided to use the cumulative catch-up method to account for this change in estimate. Good. So what do we need if we want to do the cumulative catch-up method? We have to go back to the acquisition date of the asset, and then we have to rework all our calculations. So what we don't have, we do have the carrying value of the asset as the beginning of the year, 2,793,000. We also know what depreciation has been written off on that asset. Accumulated depreciation was based on a total capacity of 40,000 units, of which 12,070 units had been manufactured up to that date. So we can work out what the cost price of that asset was. Carrying value equals cost less accumulated depreciation. we have the carry value. The carrying value was 2,793,000. Cost we do not have. Accumulated depreciation, we know how we calculate that. That is the cost less the estimated residual value, which is 0. So it's only the cost divided by the total capacity of 40,000 units multiplied by the number of units up to the beginning of the year, 12,070. So if we're going to resolve this little formula that we've written down here, we will see that the cost price of that specialized machine was 4 million rand. Now we can say, okay, let's carry on and let's rework then what the cost price less the accumulated depreciation was. That was the accumulated depreciation 1,207,000. The difference between the carrying value 2,793,000 deducted from the 4 million. Now, if we're going to apply the new estimated values, we are going to start right from the beginning. So the cost price is going to be 4 million rand. They tell us that the residual value was now recalculated at 400,000 rand. So 4 million less the estimated residual value of 400,000 divided by the new production capacity of 25,000 units. So divided by 25,000 gives us then a new depreciation charge of 140 Rand per unit. Up to the current financial year, we have manufactured 12,070 units. So 12,070 multiplied by 144 gives us then a total accumulated depreciation of 1738080. How much is currently lying in the books? 1.2 million. How much did we want to see in the books? 1.7 million. So therefore we have to bump up our accumulated depreciation with an amount of 531,080, the difference between those two. So we're going to debit depreciation expense, credit accumulated depreciation 531,080. Then we still have to provide the current year's depreciation based again on the 144 Rand per unit multiplied by the number of units that we have actually produced this year, which was 1215. So 1215 multiplied by 144 gives us then the 174,960. So total depreciation based on the catch-up method on the specialized machine will be those two figures together, which equals 706,040. And that we can dump in our PPE account. Depreciation 706,040. And now, guys, all we have to do now is just to balance off our account. So we're going to add all those figures together, transfer the total to this side, and then the balancing figure is going to be equal to the new equipment that we've purchased for the year, 1195,640. And in our cash flow statement, purchase of equipment, 1195,360. I'm going to change that. It is equipment, and it was for replacement purposes. 1195,640. That's it.